You twist the key, and the engine springs awake, pushing a wave of warm air through the vents as it fights off the cold bite of the early morning. Yet when your hands settle around the steering wheel, the sensation tightening your stomach has nothing to do with anticipation or adventure. It's fear, plain and unmistakable. Outside the windshield, a dull, never-ending Pacific Northwest drizzle smears the highway into shades of gray, echoing the dark clouds now hanging over the housing market in this part of the country. For years, you couldn't help but feel a twinge of jealousy as news stories celebrated Washington and Oregon as bulletproof places to build wealth. The narrative was everywhere: tech jobs exploding, money pouring in, and a steady influx of Californians arriving with deep pockets and bidding power. Those days, however, feel distant as you merge onto the slick lanes of Interstate 5 and head deeper into the overcast unknown. What you're seeing now tells a far more unsettling story. The for sale signs lining the road aren't flipping quickly anymore. They've been planted in carefully trimmed yards for months on end, soaking up rain, growing moss, and quietly signaling that something has gone wrong. And the moving trucks pulled over on the shoulder? They're not unloading dreams and fresh starts. They're filled with families cutting their losses and leaving the region behind altogether. What lies ahead is a sobering journey through 10 cities, where the promise of the American dream is unraveling into a financial disaster. We'll move from a once red-hot desert boomtown, now watching its housing bubble deflate in real time, all the way to a major urban center where rising crime and failed policies are dragging property values straight down. This is where the money that knows better is already running, and you need to know why. If you own property in any of these places, or if you're tempted to jump in thinking prices can't fall much further, now is the time to pause. Buying here could mean grabbing a falling knife, and the damage might be permanent. And before we arrive at the #1 city, currently drowning in a staggering surplus of homes, we've got a long road ahead. So take a second to subscribe and like the video, because we're here to help steer you clear of costly mistakes. Now shift into drive, flip on the wipers, and brace yourself. We're heading straight into the heart of the crash. Number 10 brings us to Salem, Oregon, as you head south into the core of the Willamette Valley. The steady hum of your tires on the highway follows you into the state's capital, a place long viewed as calm, predictable, and anchored by government jobs. For decades, Salem carried a reputation as a slow-moving, reliable market, largely shielded from the dramatic ups and downs that rocked housing markets elsewhere. But as you pass the towering state capitol building, it's clear that sense of safety is starting to crack. Whatever economic buffer once protected Salem has worn thin. The city is no longer insulated and is now feeling the full force of a housing market that's turning sharply downward. Not long ago, this was the go-to option for buyers who had been pushed out of Portland by soaring prices. That advantage has vanished. Home values rose so fast and so far that local income simply can't keep up anymore. Out the passenger window, you spot block after block of mid-century ranch-style homes. Just 2 years back, these places would have triggered fierce bidding wars. Now they sit quietly, week after week, as sellers slash prices again and again in subtle but desperate attempts to attract attention. The numbers backing up this scene are hard to argue with. Recent data from Redfin shows that more than 34% of listings in Salem have seen price reductions. In other words, roughly 1 out of every 3 sellers has been forced to admit they overshot reality when they priced their home. Inventory is swelling fast as well, with active listings climbing close to 22% compared to last year. Homes are also taking far longer to sell, with days on market jumping over 15% as buyers hesitate, unwilling to commit at today's high mortgage rates. What really raises alarms is the behavior of investors. CoreLogic reports that investor purchases in this area have collapsed by more than 45%, a strong indication that seasoned players no longer see a path to profit here. Even the median sale price, which exploded during the pandemic boom, has slammed into a wall and is now down nearly 3% year over year after adjustments. Then there's the final warning sign. Foreclosure filings in the Salem area have risen 12% from the previous quarter. As you leave the city behind, the conclusion is unavoidable. A concentration of government jobs isn't enough to defy market gravity, and Salem is no exception. Number 9 takes us to Olympia, Washington. You leave Oregon behind, cross the Columbia River, and head north on the interstate toward another state capital. Olympia welcomes you with dense greenery, calm streets, and postcard-worthy views along the water. Still, you know not to be distracted by the scenery. Beneath the surface, the housing market here is under serious strain. As you wind through the neighborhoods surrounding the Washington State Capitol campus, the pressure in the real estate market feels almost tangible. During the pandemic, Olympia became a magnet for remote workers desperate to escape Seattle's high prices and constant congestion. That sudden surge of demand pushed home values far beyond what the local market could realistically support. Now, with strict return-to-office policies spreading across major employers and the tech industry cutting jobs by the thousands, that demand is disappearing fast. The so-called remote work premium has vanished, leaving many homeowners stuck with properties worth less than what they owe. For anyone still optimistic about Olympia, the data coming out of this market delivers a harsh reality check. According to detailed figures from Zillow, about 55% of homes are now selling for less than their original asking price. In simple terms, most sellers are being forced to accept a painful haircut compared to what they expected. Sales activity is also grinding to a halt. Pending transactions are down 18% from this time last year, signaling a major slowdown in buyer interest. At the same time, months of supply, a critical measure of market balance, has climbed past 3 months, clearly shifting negotiating power out of sellers' hands and into buyers. Adding to the pressure, local real estate groups report that new listings have increased by 12%, pouring even more inventory onto a market where demand has essentially stalled. You can see the shift reflected in pricing behavior as well, with the average sale-to-list price ratio slipping to 98%, wiping out the era of bidding wars and above-asking offers. There are deeper warning signs, too. Mortgage delinquency rates in Thurston County have quietly risen by 9%, often an early signal that distressed sales could be on the horizon. On top of that, the median time it takes for a home to go pending has nearly doubled, stretching from about 2 weeks to nearly a full month. As you merge back onto the freeway, the takeaway is hard to miss. Olympia is dealing with a serious come-down now that the remote work boom is over, and the hangover is hitting the housing market first. Number 8 brings us to Bend, Oregon. You turn east, climbing out of the valley and over the Cascade Mountains, eventually descending into the high desert of Central Oregon. Bend is undeniably stunning. A dream destination for outdoor enthusiasts with mountains, trails, and blue skies in every direction. But as you enter town, it becomes clear you're staring at one of the clearest examples of a Zoomtown collapse anywhere in the region. At the height of the pandemic frenzy, Bend may have been the hottest housing market in the entire Pacific Northwest. Buyers fleeing California and Seattle poured in, often paying cash and snapping up homes without ever setting foot inside them. Now, as you pass sleek luxury condos and sprawling new developments on the west side of town, the quiet is impossible to ignore. The trails and breweries are still busy with visitors, but the open houses tell a very different story. They're nearly deserted. Bend's housing boom was built on 2 assumptions: that remote work would last forever, and that cheap, easy money would always be available. Over the past year, both of those supports have collapsed. The result is one of the most dramatic market reversals on this entire trip. Data from Realtor.com shows that the median listing price in Bend has already fallen about 6% from its peak, marking a sharp and sudden correction. Supply has surged as well. Inventory is now roughly 40% higher than it was just 12 months ago, flooding the market with options and putting buyers firmly in control. Homes aren't moving like they used to either. The absorption rate has dropped sharply, and properties now sit for a median of 55 days, an eternity compared to the frantic, blink-and-you-miss-it pace of just 2 years ago. One of the most alarming shifts is happening in the investment market. Vacancy rates for second homes and rental properties have climbed to nearly 8% as short-term rental income dries up. Many owners, facing shrinking cash flow, are choosing to sell rather than bleed money. Builders are feeling the pressure too, with permits for new single-family homes down 25%, signaling fear that demand is about to fall off a cliff. Even pricing fundamentals are slipping. The average price per square foot has dropped by 4%, wiping out gains for recent buyers who arrived late to the party. And nearly 42% of active listings now include aggressive price cuts. a clear sign that sellers are chasing the market down. As the dust settles across the high desert, the verdict is clear. Ben's explosive boom has ended, and what remains is a market trying to find its footing after the bubble burst. Number 7 brings us to Tacoma, Washington. You roll down from the mountains and re-enter the familiar gray, rain-soaked stretch just south of Seattle. This is Tacoma, often called the City of Destiny, a place that for generations has been more industrial, more affordable, and more blue-collar than its flashier neighbor to the north. But as you cruise through areas near the port and into downtown, it's obvious that Seattle's overflow demand has done real damage here. When buyers could no longer afford Seattle, they pushed south and drove Tacoma's prices to levels that never made sense for a working-class city. Now that Seattle's own housing market is losing momentum, Tacoma is being squeezed from both sides. Long commutes and endless traffic have worn down the daily travelers, while investors are growing frustrated as profit margins shrink. Rising interest rates and bloated home values are putting intense pressure on the very foundation that once made this city accessible. The numbers confirm what the streets already suggest. Tacoma's market is slipping fast and entering correction territory. Data from the Northwest Multiple Listing Service shows that active inventory has surged nearly 95% compared to last year, almost doubling in a very short time. That kind of supply shock is more than this market can comfortably handle. At the same time, closed sales have dropped by 22%, a clear sign that buyers are stepping away rather than engaging at current prices. Home values are starting to reflect the shift. The median price in Tacoma has fallen about 5%, a painful reversal for homeowners who bought near the peak. Financial stress is also becoming more visible, with foreclosure starts in Pierce County rising 14%, signaling that some borrowers are already in trouble. Adding to the strain, the average monthly mortgage payment now eats up more than 45% of the area's median income, making homeownership mathematically out of reach for many locals. Even deals that make it to the finish line aren't guaranteed anymore. The cancellation rate on pending contracts has jumped to 16%, meaning more buyers are backing out due to financing problems or inspection surprises. And the pressure isn't limited to homeowners. Rental vacancies have crept up to 6%, showing that demand is cooling there too. Tacoma is feeling the impact of Seattle's slowdown in a very real way. When the larger market sneezes, the smaller one catches a cold. If you're finding this data-driven breakdown helpful, take a moment to like the video and drop a comment about which city you think we'll explore next. Your support helps us continue digging into the real story behind these changing local economies. Number 6 takes us to Medford, Oregon. You continue driving south, pushing closer to the California border until the valley opens up around you and Medford comes into view. Ringed by scenic mountains and long known for its agricultural backbone, this city is dealing with a set of problems that are dragging its housing market down faster than what's happening across the country. As you make your way through town, the strain from a weakening local economy is easy to spot. One of the biggest blows has come from the collapse of Southern Oregon's legal cannabis industry. What was once a major source of income has left behind excess land and unused properties that are no longer producing revenue. That financial shock hasn't stayed contained. It's spilling directly into the residential market. On top of that, Medford has traditionally attracted retirees, but rising inflation has eroded fixed incomes and pension funds, causing that once reliable buyer base to disappear almost overnight. Every key metric here is flashing warning signs. According to local housing reports, months of inventory have climbed to nearly 4, handing negotiating power to buyers for the first time in years. The median home price has fallen 4.5% over the past 12 months, and the pace of that decline is picking up. Sales activity has slowed sharply as well, with the number of homes selling each month down by 20%, effectively freezing liquidity and trapping sellers in place. Homes are also taking far longer to move. Days on market have ballooned to roughly 65 days, meaning a new listing could sit for 2 months before receiving a serious offer. Builders aren't optimistic either. New construction starts have dropped 30% as rising material costs make projects financially unworkable. Affordability has deteriorated to historic lows, pushing an estimated 70% of local households completely out of the buying pool. There are additional stress signals beneath the surface. The share of loans in delinquency or forbearance is running about 3% above the state average, hinting at growing financial distress among homeowners. Meanwhile, price reductions are everywhere, with 38% of sellers cutting their asking prices in hopes of attracting interest. As you leave Medford behind, it's clear the city is caught in a downward spiral, and for now, there's no obvious way out. Number 5 brings us to Spokane, Washington. You leave the southern valleys behind and begin a long, draining drive northeast, climbing over the rugged Cascade Mountains and crossing the state until you finally roll into Spokane. Often referred to as the capital of the Inland Empire, this city was one of the biggest winners of the pandemic-era housing surge. It promised urban conveniences without coastal price tags, pulling in waves of remote workers eager to escape rain, congestion, and the political climate of Western Washington. But as you pass through Spokane's historic South Hill neighborhoods, it's obvious that the boom has reversed with surprising force. Longtime residents who were pushed out by soaring prices are still frustrated, while many of the newcomers who helped fuel the run-up now find themselves stuck in homes they can't easily unload. The energy that once made Spokane feel like a modern-day gold rush has slammed headfirst into reality. The numbers tell a sobering story for anyone hoping to sell. According to Redfin data, the supply of homes on the market has jumped more than 35% compared to last year, creating a surplus that buyers are largely ignoring because the finances simply don't pencil out anymore. Prices have stopped climbing as well. When adjusted for inflation, the median sale price is down nearly 3%, signaling that real value is slipping. Homes are also taking much longer to move. Listings now sit for an average of 45 days, a sharp and painful contrast to the single-digit timelines seen just 2 years ago when bidding wars were routine. Nearly 40% of current listings have already undergone price cuts, a clear sign that many sellers are struggling to accept how quickly the market has changed. Builders aren't taking chances either. Permits for new single-family homes are down 20% as developers pull back to avoid adding supply to a declining market. Migration trends are also shifting. Reports show that the flow of people moving into Spokane has slowed dramatically, cutting off the main engine that once drove appreciation. And perhaps the clearest signal of all, the sale-to-list price ratio has slipped below 100%. That means paying over asking price is no longer the norm. It's a relic of the past. In Spokane, the seller's market is officially over. Number 4 takes us to Gresham, Oregon. You turn back toward the west, heading into the outer edges of the Portland metro area, but stop short of the city itself. Gresham, Oregon's fourth-largest city, has long been viewed as a more budget-friendly suburban choice for people commuting into Portland. Yet as you cruise along its main thoroughfares, the mood feels noticeably heavy, almost tense. The challenges that have weighed down Portland, rising crime, visible homelessness, and growing concerns around public safety, haven't stayed contained. They've spilled directly into Gresham, and the housing market is paying the price. Buyers aren't focused solely on finding something affordable anymore. Safety has jumped to the top of the priority list, and an increasing number of families have decided Gresham no longer checks that box. The data paints a troubling picture. Local market analyses show that median days on market have jumped to nearly 50 days, a clear signal that buyers are hesitating at current prices. Closed sales have fallen sharply as well, dropping 19% compared to last year, which points to shrinking liquidity and homeowners struggling to move their properties. At the same time, inventory has grown by 25%, forcing sellers into fierce competition for a steadily declining pool of qualified buyers. Signs of distress are becoming more visible. Foreclosure filings in Multnomah County, which includes parts of Gresham, are up 10%, hinting at mounting financial pressure. Home values are slipping too, with the average sale price down roughly 4% as demand continues to weaken. Active listings have climbed to a multi-year high, suggesting that both investors and longtime residents are trying to exit before conditions worsen. Even the rental market is losing steam. Vacancy rates have risen above 6%, putting landlords in a tough spot as units take longer to fill. Perhaps the most revealing statistic of all is that more than 45% of homes sold in the last quarter closed below their original asking price. Gresham now finds itself trapped in a cycle of negative perception and declining pricing power, and the market momentum is clearly moving in the wrong direction. Number 3 brings us to Yakima, Washington. You cross back over the Columbia River and head straight into the agricultural core of central Washington, where Yakima sits surrounded by endless orchards and vineyards. The landscape is beautiful, but it masks an economy under serious strain, one that's dragging the local housing market down with it. Unlike cities built around tech and high-paying office jobs, Yakima depends heavily on agriculture and labor-intensive industries. Those sectors are being squeezed hard by inflation, rising operating costs, and thin margins. As you drive through the city's neighborhoods, it becomes clear this isn't a market unraveling because of speculation or overhyped investors. Instead, it's weakening because the people who live and work here are simply stretched to their limit financially. Housing affordability in Yakima was never fueled by strong incomes. It worked because prices stayed low. Now that interest rates have climbed sharply, that equation no longer works for the average worker trying to buy a home. The numbers coming out of Yakima reflect just how serious the situation has become. Zillow data shows that year-over-year home values have completely stalled, posting zero growth and slipping into negative territory for the first time in several years. Mortgage delinquency rates in the county are among the highest in Washington, climbing to nearly 4%, a well-known early warning sign for future foreclosures. At the same time, active inventory has jumped by 30% as homes sit on the market month after month without attracting offers. Market momentum has slowed to a crawl. Months of supply have pushed beyond 4, firmly establishing a buyer's market. Buyer confidence is clearly collapsing as well, with mortgage purchase applications down 25%. Pricing pressure is showing up across the board. The average price per square foot has already fallen about 2% in just the last quarter. Adding to the imbalance, new listings are up 10%, pouring even more supply into an already saturated market. And perhaps most telling of all, homes selling above their asking price have become almost unheard of, accounting for less than 10% of all recent sales. If this candid look at Yakima resonates with what you're seeing locally, drop a comment below and let us know whether prices in your neighborhood are starting to slide too. Number 2 brings us to Portland, Oregon. You head west straight into the storm, crossing the city's steel bridges as you enter what was once proudly called the City of Roses. Not long ago, Portland was the media's favorite success story in the Pacific Northwest, a hub for culture, food, creativity, and steady growth. Today, as you move through downtown and nearby residential streets, the signs of decline are impossible to miss. Sidewalks are lined with tents and blue tarps, while for lease signs hang in the windows of empty storefronts that once housed busy, profitable businesses. What's happening here goes far beyond higher interest rates. Portland is facing a deep crisis of confidence. Rising taxes and ongoing public safety concerns have pushed many high-income residents to leave, hollowing out the tax base and draining demand for both luxury homes and mid-range housing. The housing data reflects just how severe the situation has become. Recent reports from the regional multiple listing service show that Portland's median sale price has fallen by more than 5% year over year, representing a major erosion of homeowner wealth. At the same time, active residential listings have jumped nearly 30%, saturating the market with homes buyers are unwilling or unable to purchase at current prices. Homes are sitting longer too. The average time on market has stretched past 50 days, a sharp departure from the fast-moving conditions of recent years. Downtown commercial real estate is in even worse shape, with vacancy rates hitting record levels. That weakness is dragging down the value of nearby condos and mixed-use developments, creating a ripple effect across the city. Digging deeper, you uncover an even more troubling trend. Multnomah County has lost more than $1 billion in adjusted gross income due to outbound migration, a devastating hit that threatens long-term property values. Financial stress is rising as well, with foreclosure filings up 15%. Sales volume has collapsed, with the number of closed transactions down 23%, signaling a market that has nearly stalled out. To move properties at all, sellers are being forced to make painful concessions. More than 40% are now offering significant incentives just to close a deal. As you continue through the city, the conclusion becomes unavoidable. Portland is firmly in correction territory, and the market hasn't found its bottom yet. Number 1 brings us to Seattle, Washington. You head north on Interstate 5 for the final stretch of this bleak journey, eventually rolling into the Emerald City. Seattle has long been the economic powerhouse of the Pacific Northwest, anchored by giants like Amazon and Microsoft. For years, the city carried an aura of total invincibility, but as you pass rows of cranes and gleaming glass towers, it becomes clear that this is exactly where the downturn is hitting with the most force. The tech industry, the very engine that drove Seattle's explosive price growth over the past decade, is now bleeding jobs by the tens of thousands. Stock-based compensation, which many buyers relied on for massive down payments, has taken a severe hit as share prices fell. Seattle sits at the center of this collapse because it simply had the furthest to fall. The numbers coming out of the region are alarming. Redfin data shows that the median sale price in King County has dropped nearly 10% from its peak, wiping out hundreds of thousands of dollars in equity for recent buyers in just a short span of time. Inventory has surged as well, with some neighborhoods seeing year-over-year increases of more than 40%, an oversupply that could take years to fully clear. The high-end market is effectively frozen. Luxury home sales are down over 30% as wealth dries up and confidence evaporates. Tech layoffs have removed a massive segment of qualified buyers from the market, and it shows. Homes selling above asking price have plunged from more than 70% to under 20%, marking a complete reversal of seller leverage. Even rents are beginning to soften, widening the gap between renting and buying to the largest level Seattle has ever seen. That imbalance is pushing would-be buyers to the sidelines. Foreclosure activity is also starting to rise, with filings up 13% as adjustable-rate mortgages reset and monthly payments jump. Investors have already made their move, or rather, their exit. Investor purchases are down a staggering 50%. A clear signal that experienced money has walked away from Seattle, at least for now. You pull over at Cary Park and look out across the rain-soaked skyline, the city fading into shades of gray. The road trip may be over, but the real risk to your finances is only beginning. We've just traveled through 10 cities where supply and demand are badly out of balance and where patience could save buyers tens, if not hundreds, of thousands of dollars. The Pacific Northwest remains breathtakingly beautiful, but right now its housing market is a financial minefield. Don't let fear of missing out push you into a costly mistake. If you want to stay ahead of the crash and protect what you've worked so hard to build, be sure to like this video, subscribe to the channel, and share this warning with anyone considering a move here. And leave a comment below telling us which part of the United States we should take our next road trip through. Thanks for watching, and drive safe out there.